John Davies, really looking forward to talking to you again, my trading warrior brother. Making you the presenter. Looking forward to hearing your voice. Not sure if you're going to be screen sharing with us today. John, how are you? Welcome to F.A.C.E.
Thank you very much, Dale. It's a pleasure to have a chance to speak with you and your listeners today. I really do appreciate this opportunity. And,
Thank you, John. When was the last time you and I had a conversation?
Well, the best conversation we had, it was kind of funny because it was just before Christmas, and I was in New York, and just as we were talking online, as you remember, the dogs began barking, and then someone started to do some repair. So we had saws going off and dogs barking. So I was all ready to talk to you, and I had everything all set up, and then just all of a sudden,
who let the dogs out?
That's right. Christmas in New York. But
all right, John. So you're not going to be screen sharing, so I'm going to be flipping around on different markets.
You've got some great, and first of all, I want to thank you for having me on your show, and listeners. You have a tremendous show. I was just loving Steve's discussion beforehand, and I hope to add some. I hope I can interject some value and some long-term considerations to investors, because I think that's one of the things that's missing in today's market often. Right.
Yeah. So immediate gratification is what people are looking for. They're in the trees. They're not looking at the forest. In fact, they're so micro, they're picking off the leaves of the trees. You know what? Every 10 minutes.
Brilliant idea. I mean, we went from an investment community when you and I were young men.
I don't remember.
That focused on long-term asset development, wealth accumulation, and wealth protection, to really an era of flipping. So much that many investors no longer have a position because they're constantly flipping out of position. And certainly, if you're in the futures world, that's obviously it's a completely different game. But for the vast majority that are involved in equities, they're often, I think it's because they're no longer considering fundamentals, no longer considering long term, and they're looking for such short little hits. They're missing the big long term appreciation. Right.
Okay, so I just posted. I'm showing the weekly S&P chart here, John, and we had this tremendous rally from late last year when your dogs were barking to the recent highs up here. And go ahead.
Yeah, and it was it was almost a very transparent and predictable rally, I believe.
Yeah, it was strictly jawboning by the Fed backing off and sitting and holding hands with Bernanke and Yellen, all three of them.
Without question. And so for investors, at that time, we were talking about things like FCX, tech, in situations, and really it applied to everything. For typical equity investors, and this includes your American investors who are in 401ks that allow options, why don't we look at these situations and we can see very, very telegraphed, what I call telegraphed, I guess that's even a term that not even people know today, telegraphed movements, to use it to write calls and to purchase some at that time, into rallies, relatively inexpensive downside protection. And I think the biggest problem that we have today is not only is that we are so much focused on technical analysis, which I certainly agree with, but we're not spending enough time on fundamental analysis and spending near no time on risk management. And risk management should be the priority of your standard retail investor. And it was one of the first things a professional in the brokerage industry, 35 years ago would talk about. We're going to protect your money and create an opportunity for it to grow.
Right. So, the interview is really becoming crystallized to me since you brought up Freeport. And I remember it, and you liked it down here.
Yeah,
And
no,
you had a combination of being long the stocks, and your strategy is to have sold enough premium to
that's
where it
right.
was kind of riskless, and that was a great trade. I mean, you had
And
a
and it worked.
25-30% rally.
Yeah, and
How
the greatest.
how did you know when to exit it, John? Because here
Well,
we are revisiting it.
that's really it really comes down to disciplined trading. In other words, when you make, I tell people, look, my goal is to eliminate the cost of investment in one shape or form, typically through the writing of calls, or maybe if you're acquiring through writing of out of the money puts and then later on writing calls, right?
Hmm.
My goal is to reduce the cost of the investment completely within 30 months. And that kind of, for an investor today, when you say 30 months and eliminating the cost, that doesn't seem too exciting to them because they haven't done the math. And what we're saying is we're getting the 40% rate of return. Now, when you can be taking yourself home approximately 0.8% of the stock value in premium per week, it's not too hard for us to do a little bit of math and saying we're getting over 40% rate of return for basically a rental agreement. So there comes a time where you have to, and this is all an individual investor. And when I press that amount of saying, okay, I'm getting 40% ROI here. And now I'm then looking at the chart and saying, well, your FCX. And once we jumped in at FCX and we looked at it, and we got our cost at below $10, and we quickly brought it well below, 8.5, and then it starts pushing to that $13 mark. It's time to
Sure.
get out and
Okay,
say,
so you took it here.
yeah, and that's where we said, okay, that was a nice place to exit. We did the same thing with a company that's a little bit less traded in the United States, Hudbay Minerals,
Okay.
and Hudbay Minerals was the same thing. In Q4 earlier, we suggested purchasing it.
What's the symbol, John? What's the symbol? What?
HBM. HBM.
Got it.
And HBM is, again, it's mostly a Canadian company
I see
and
it.
mostly known in Canada, but it's a beautiful little mining company. Particularly when it's
Depressed.
yeah, and yeah, well, when it's a distressed price,
Yeah.
and
Aren't
and
all the miners?
well, they are because, again, investors of 2019 aren't so interested in commodities. And, Dale, my history basically comes from the commodity sector. But what I quickly realized as a long-term investor that, you know, using equities and using this theory is a much easier way for long-term portfolio or approach to portfolio management, more proactive. Well, here's my, and you've got so many great people on your show. I could listen to the prior Steve any time, every day, and yes,
We won't
and
even charge you. It's free.
there we go. and when you listen to it, one of the things that you have seen now in the investment community is a lack of interest in commodity bases and commodities. The investor himself, the retail investor.
Yeah.
And this is, it's interesting because you've got many firms now suggesting there's going to be a great commodity bull market, and I'm certainly in agreement with it. And they're
Is it going to take a turn in the dollar for that to happen, John?
well, that's when it takes a mighty whipsaw. Now, I think what we're going to have is we're going to have strength in the commodities, but before then we're going to have weakness. In other words, as Stevio suggested, I'm in complete agreement that crude has been breaking down. That's where my focus has been watching for the last little while. You can watch just crude just shake down, and I think we've got a $55, a 55 coming, right? But within that, then we've got all those opportunities within the big names. The big names in the pardon me, in the
I know
petrol.
some guys, John, that are looking for the January lows to be violated. Can you see
Well,
that happening?
well, see it happening. I'm not positive. I will definitely have my position.
Well, you never could be.
Yeah, exactly. Could it absolutely look? This is a period. This is one of the great period of investments for savvy investors, in my opinion, because we've got such extreme volatility. You know, you've got the head bay chart up, and if you look at it, this thing was hideous just around when we were talking. It was around
Right,
just under 450 just before Christmas, and
right.
we watched that rally above 7. And I was very vocal on this because it really is an equity that should be at some time around 7 or 8, right? In the above 7. But of course, it has this big whipsaw, and it tends to get oversold. Well, and of course there's some backdrop to this with board situation, but it took that run just last month above considerably above $7, where it's time to say goodbye and say we'll visit again. Well,
Are any rare earth minerals in this mining company?
you know what? The big play with Hudbay Minerals is really as a base metals.
Okay,
This is in
copper.
many
So
ways
it's a proxy for copper?
it is a very good proxy for copper, but it also tends to, because of its the way it's traded, let's say, it tends to oversell. It tends to really be highly dramatic, we'll call. But you've got great proxies with FCX. I mean, that's obviously FCX is the beast, right? Yeah, and a
Right.
great one for you to look at Bitcoin here. But so you get these situations. Well, this is just a standard situation. You make money as an investor on the buy side. That should be the most obvious thing, but sometimes we forget the obvious things. So now, do we want to be buying these situations cheap? Well, we get these great sell-offs. Now, when we get these sell-offs, like for instance, what I'm doing right now with something like FCX, because I believe so much in Freeport, right? I mean, it has a company with tremendous long-term value, and if you believe in the return of infrastructure, now we could see a shakedown. I think there's going to be a shakedown where copper could even test the 245 mark, right? That's something we have to consider because this is a very uncomfortable month or two, right?
Because of the trade war or
Trade
because of
war.
seasonality?
Well, the big thing is trade war. We've got a G20 meeting where the investment world, G20 at the end of the next month, the investment world is going to be watching everything like a hawk, right? And watching various things. So it tends to be overly dramatic, and it really is hurting. It's hitting commodities straight in the face, right? So you know when Freeport went below 980.85 earlier last week, we were selling out of the money puts. I want to acquire it cheaper, right? That's my
What
goal.
strike are you selling?
Well, I would look at cascading. I love getting in the 9s and 8s, like low 9 and 8s. So when I say a cascading, again, you go when you're logging in, when you're rolling into a position. Let's just say, for math's sake, you're going to buy 800 shares. We might look at incremental purchases at 1/8 marks. So you might roll into be long 200. Write 2 calls, then write 2 puts at a certain price, right, the lower, and then write another 4 puts at an even lower price. So what you've done is you've went out and said, I'm looking to acquire in 8 units at the stock at a certain price, but you're gradually lowering your price. So assume if the stock actually lowers itself, although you don't really anticipate that, but you're paying for part of the investment. So it makes it kind of a very simple tactical play for you, right? So it's easy in that regard. So with these, you're always, when you start on your accumulation, you start in a buy right. And you're putting yourself always in a positive situation, a positive trade. In other words, you're always winning in it, but your goal isn't necessarily to acquire and watch it run today as much as you would like that. Your goal is to write down the cost of the investment. Now, that works even greater, or I should say even greater, that works even more easier to illustrate with people who buy stocks that have a dividend, are income investor. And given the fact that such a high percentage of our population is in or nearing retirement age where they're going to be looking for income in their investment portfolio, I really hope, and I'll do my best to do this personally, is that we can teach a generation of mature investors how to use options to increase their return on investment on a monthly and quarterly basis, as well as provide considerable downside protection. So in other words, not only they're not simply hoping for that or planning for that, 5 to 8% dividend yield, but they're doubling and trebling that ROI, and also with a level of comfort, right?
How do you do that, John? Because I don't see a website. Do you just have? How are you mentoring people, and just from people you find on Twitter?
Right. That's right. I'm just mentoring, and I'm not trying to promote any service that I offer. To be quite honest, I enjoy helping the investment community. I do help investors on that, but I'm not using my Twitter feed or website or online presence to promote in that. I'm helping where I can. I do have private investor meetings and things like that, and working with hedging groups and hedge funds on just a private basis. But within the online community, as much as I could do to help, I will. And I don't want to make that into a
business.
A fee for service, because this is something that, Dale, and our youth, this is something that the investment community, certainly the ones that I was involved with, helped teach a generation. This is the classes that I taught in the early 1980s on how to help people learn to hedge funds better, hedge their investments, make extra money, and build a future. So I'd rather give this away than try to sell it with something, because besides, there are some people that offer tremendous services, that I just want to be a part of helping, right?
Okay, well, do you think a part of helping is that we've had a prolific bull market? I was talking about the weekly in the S&Ps for with Steve and Stelios, and it's become more of a two-sided market here since the last year or so. And when I look at the S&Ps, we've been here before. We're right at major support, but when you look at this, and in fact, let's bring up a monthly, John, because I want your impression. So, okay, this was the Great Recession. Was it great for you? I ask people that all the time. All right. Anyway, the Great Recession, right? So this was, a 70% loss of value. Now, I'm not saying that's going to happen, but, I can make a case for 2,200. So do you have to shift your strategies? And, eventually, who knows when, 2022, 24, this prolific bull market brought on by central planning could end and correct 50% of this advance from the lows in. So do you have to change your strategy from looking for things to buy and write calls, to looking for things to short and write puts?
Yeah, see, one of the things that I am always, going back, it sounds like, doing an ad for Wall Street Weekly, but I always believe Louis Ruggiser's comment of flight to quality. In other words, always look for quality. Yeah, well, and if you're looking at
even in stocks, so like blue chips,
things that you believe in, but also I'm also strongly commodity based. But I also, as far as I believe in, those tangible assets that people believe in, invariably that goes into energy, and related into the mining sector. There might be a few differences, a few variations from here to there, but that's in basics where I typically go to. Now, I believe at all times a person should be hedged always. So, and it will vary from individual to individual. These past 3 weeks, I write calls on a weekly basis. I've been writing more in the money calls. So I'm basically stripping out the option. I'm stripping out the premium theta. We can talk about that, the time value on those options each week, so that I've got a lot of downside protection on that. Now, last week I entered into a situation where I started to go long into FCX and tech. Had a little bounce, and I also initiated the start, which would be a long calendar spreads. But that was just the start of it, and with those, I will start to write off the cost of the investment over a many period of time. Really, it's going to stretch into the new year on that. But my belief that they are at or near within 10% of their base. Now, within the index, I believe every investor of some level, certainly if they're able to invest in equities, I guess you could say that they're at that level, should be looking at some sort of indice put, long indice put, that downside protection. Whether or not
people have been saying that's a waste of money, like fire insurance on your house is a waste of money.
That's exactly it. You lock your, if you're like me, you locked your doors at night, when your children were little because you're terrified of anything. So why wouldn't you protect your money? Now the same thing goes with your,
you know what, John? You just reminded me of something. Have you ever heard this? What good is happiness? It can't buy you money.
it's
Anyway, you're a mining guy. You're a mining guy. So I'm putting up this gold silver ratio chart, John, because I think we're peaking.
Oh, okay, I believe you're absolutely right.
And all right, so here's the long term, right? We're back at the highs that we had in 08 before it really came in, and this was a Fed, right? So silver outperformed gold here, gold's outperforming silver here, and I think we're getting close to a turn. Do you think that, I think the mean or over time, in my career, I was kind of used to seeing it in this range, around 40 or so. Is that what you've noticed too?
Without question, it's percolating. One of the great interviews you had on not so long ago was David Brady, and and just fabulous. David's brilliant, and one of the things to me it looks like, for lack of better terms, gold is percolating. In other words, you get that positioning, the weakness, and you can see it rip, and it's going to rip after we get one more pullback of the S&P, and it could be a profound one. I'm hoping it's not for just simply the retail investors and our 401k people, right? And that's just my hope. But we're going to get that, and then we're going to see the Fed make its move, and we're going to see then gold profoundly, right?
Okay, I have an expression about hope too. I'm like Jimmy Durante. I have a million of them. Hope is the oxygen in our life, but the carbon monoxide in our investing.
That's another good one. I like that.
So, when do you? So the risk management side is basically where you're, say you're long a stock, you're writing calls. Your risk management is there. Say Freeport went to 7. What do you do?
Well, I mean, for that situation, with Freeport going to 7, that's when you're 8. At that stage, you're looking at, full collapse, and the equity, because you're looking at a significant, or not full collapse, but you're well past your panic point. And that is because that's one of the reasons why I like using weekly options. Now, once weekly options, you're able to make a bigger adjust quickly. You obviously have a greater theta, meaning the time evaporates quicker. I think I explained that correctly. When the options expire, we're able to constantly adjust. Now, if it's any clue, in the last 3-week period, I have been writing in the money calls. So I'm chopping out what I can. I'm chopping out that small ROI, which is basically 0.5 to 0.75 of the equity price per week. That still is considerable, right? When we look at it, but it gives me that greater comfort zone, right?
Yeah. Okay.
Now,
so
go ahead. For investors, but the whole thing that I really want to impress upon investors on this, most important thing, in my opinion, is that they look at these situations going, I'm not going into positions naked. I've got some downside protection. And if we can this is such an extraordinary period for investors because we can protect our downside like no other period more easier in history. And whatever. But just don't go into these situations blind and without a long game perspective, right? Now, with all of these situations, we're going to see the one thing we can count on. If you're an investor in commodities, one thing I believe you're going to be able to count on now is a lot of whipsawing. Crude is going to, we're looking like we're breaking down. We're going to possibly test that 55. They can see it. And then there's all sorts of fundamentals that suggest we could see, the 70s rip hard, right? And the same thing with copper. Copper is definitely going to test some lows and hopefully affirm its support level. But the fundamental side of copper, there isn't going to be another copper mine in serious production under the $3 mark, and we're already in a significant supply deficit, right?
Okay. All right. Well, I tell you what, John, is there anything you wanted to wrap it with? And I know the best way for people to follow you, and I recommend that people follow you at Renegade Style. Why don't you just tell me what was behind the handle? You consider yourself a maverick, a renegade?
Yeah, you know what? That's always been my modus operandi. A contrarian, someone who did things completely different. And I think one of the things that I want to tell people, I hope that they can look at people, certainly the options group in Chicago do the best job in the industry. But I always tell people, in 36 years, I've been able to figure out markets go down each week or markets go up, but no one can predict that. But each week, option premium decays. And that is your great gift for the retail investor to take advantage of that marketplace, write down your cost of investment, because none of us can come up with a yield of investment that costs zero. In other words, it's infinite. And we can all have very safe, comfortable portfolios and eliminate risk and enjoy the benefits.
Great way to wrap it, my trading warrior brother.
Thank you very much.
Markets go up, markets go down, options always decay. Love it. So, John, really great talking to you again, and
thank you very much.
Much success between our here and our next conversation. And
I look forward to listening to you shortly.
Yeah, may every option you write turn to dust.
Thank you very much. There you go.
I bought a few. I've seen it, so it happens. So, thank you, John Davies. Everybody, follow John at Renegade Style on Twitter and learn how to be the house. So the house sells the option that all the retail guys come in and buy. So that's a wrap for us today. Remember, don't just count your pips, count your blessings. You're welcome, Tom. Tom enjoyed you, John, and so did Elena. And thank you for edifying F.A.C.E today, John. And really appreciate your time. Because,
thank you very much, sir.
All right, buddy. So that's a wrap, everyone. See you, Glenn. See everyone. And remember, I know where your stops are. Dale Pinkert at Forex Stop Hunter. And you know what? Sometimes people know where mine are too. So have a great rest of the session. Don't forget to take advantage of the Memorial Day sale. And we'll see everyone tomorrow. I have Anthony Crudelli on. Anthony also hosts and talks to a lot of great people. He learned the business on the floor. So I'll see everyone tomorrow. Enjoy. Adios. See you, John.
Thank you.